presentations of the semester. We have 3 domestic and 1 international stock today. As a reminder, we manage $3 million of money for Marquette University in 3 separate portfolios, 2 of which are stock or equity, and 1 is a fixed income fund. On the screen behind you, you'll see the stocks appearing that we presently own in the portfolio. The task today is for our 4 presenters to convince you, the seniors in the AIM class, that these stocks should be added to the portfolio. They'll also be recommending which stocks should be sold and these new stocks replaced. The process that takes place is the students spend anywhere from maybe 20 to 40 hours researching these companies, building models, studying the industry, doing the write-ups, and then the presentation today that you'll see, which is a very important part of the AIM program. We're going to have Connor talk for about 5 to 7 minutes, pitching this company, pointing out the features that he likes about it, and answering questions for about another 10 minutes after that. So thanks for joining us today. We're going to have people online with us, and we'll be fielding questions from the audience. You're invited to ask whatever questions you want, as well as having people online pose questions. So, Connor, ready to go?
Yep.
Good luck.
Thanks. Okay. Hello, everyone. My name is Connor Jones, and I'm a senior in the AIM program covering the domestic and international energy sectors. Before we begin today, I would like to kind of touch on my screening process. So when I was looking for a stock, I wanted to look for a company that was involved in the renewable energy space because our portfolio is currently heavily weighted towards Permian Basin oil and gas companies, and I believe the firm with operations in solar and wind would provide stable, tax-shielded cash flows that also diversified our holdings. Through that process, I found Terraform Power, ticker TERP. Terraform Power acquires, owns, and operates solar and wind assets in North America and Western Europe, and earns revenue by contracting out the energy generated at these facilities. TERP operates through 3 segments: solar, wind, and regulated solar and wind, that comprise a 3,738 megawatt portfolio underpinned by long-term contracts. TERP is sponsored by Brookfield Asset Management, a leading global alternative asset manager with a long history of owning and operating physical assets with a focus on renewable power. Moving on to my recommendation. In 2017, Brookfield began sponsoring TERP and has made significant progress in improving operations and enhancing shareholder value. Since that time, TERP has been active in the M&A market with the acquisition of SEDA, a renewable power company which established a platform for growth in Europe, the addition of AltaGas's distributed generation portfolio, which more than doubled their capacity for DG, as well as other bolt-on acquisitions. In order to provide sustainable growth outside of M&A, management invested $28 million in organic growth initiatives. Alongside that investment, TERP has rolled out a solar improvement plan and converted their wind fleet to long-term service agreements with GE in order to enhance current asset value and reduce costs. Through this focus on operational efficiency and margin enhancements, management has been able to provide additional value through consistent dividend payments. In 2019, management is targeting a dividend per share of 81 cents, representing a 4.6% yield, and aims to grow this dividend by 5 to 8% annually. Based on TERP's ability to generate high-quality tax-shielded cash flows and stable dividend growth through a diverse portfolio of renewable power assets, it is recommended that Terraform Power be added to the AIM Equity Fund with a price target of $22.22, representing a 24% potential upside. Moving on to my first driver. In 2017, Brookfield Asset Management began sponsoring TERP and now currently holds 65% of the shares outstanding. Brookfield's expertise in renewables has greatly benefited TERP, which can be seen through the 26% increase in revenue and 34% increase in net income in 2018. Under the sponsorship agreement, Brook grants TERP the right of first offer to acquire renewable power assets that are being sold by Brookfield or its affiliates, and this ROFO portfolio currently stands at 3,500 megawatts. Along with the ROFO agreement, Brookfield provides TERP with a $500 million revolving sponsor line of credit to fund acquisitions and growth capital expenditures. This sponsorship provides TERP the ability to source off-market transactions at more attractive valuations than the auction process. The access to capital and deal sourcing capabilities of Brookfield provide TERP the opportunity to grow through M&A and take advantage of economies of scale. Next is TERP's distributed generation platform. And before I begin, I would like to explain what distributed generation is. A DG solar unit provides customers an alternative to traditional utility energy suppliers that is usually smaller in unit size and can be installed at the customer's site, eliminating the need for lengthy transmission and distribution lines and the costs associated with those. By bypassing traditional utility suppliers, DG systems de-link the customer's price they pay for power from external factors such as commodity price fluctuations, leading to more stable cash flows and revenue generation. In July 2019, TERP announced the acquisition of AltaGas's DG platform, which more than doubled their DG portfolio, making them one of the largest players in the U.S. market. The DG market, which includes residential and commercial solar, is projected to grow at a CAGR of 11% through 2026. With TERP being one of the first downstream renewable asset investors to enter this market, management is determined to take advantage of their position. To accomplish this, Brookfield hired a DG development team to work with TERP as they build out their platform. With residential solar installations increasing 8% in 2018 and another 7% year-to-date in 2019, TERP will have the opportunity to extract incremental value through cross-selling opportunities with Brookfield's $194 billion real estate portfolio. My third driver is TERP's wind repowering opportunities. TERP currently is targeting 3 repowering projects for their wind fleet. These projects will include access to 80% production tax credit safe harbor turbines and are estimated to be completed at a 40% discount to their new build wind fleet. Included in this process is the change in equipment from Clipper to GE under long-term service agreements that mitigate operational risks and lock in cost savings. The new wind turbines have a larger rotor diameter, which is expected to increase energy production by 25 to 30%, leading to an increase in profit per turbine. These repowering opportunities highlight management's ability to enhance existing asset value and improve operational efficiency in order to drive shareholder returns. For my valuation, a 5-year DCF was constructed that resulted in an intrinsic value of $21.88. Additionally, a weighted average EBITDA multiple valuation was conducted that resulted in a value of $20.66, and a weighted average price to cash flow multiple valuation resulted in a value of $24.38. Finally, due to the size and growth of their dividend, the dividend discount model was calculated using their trailing 12-month dividend, a growth rate of 5%, which is at the low end of their guided range, and a cost of equity of 8.47%, resulting in a value of $21.93. By weighing the 4 models equally, a price target of $22.22 was reached, resulting in a 24% upside, along with the payments of a dividend yielding 4.6%. In the interest of time for questions, I'm going to skip my risks and briefly touch on management. John Steinbaugh became CEO of Terraform in 2017 when Brookfield began their sponsorship. Before that, he worked as a managing partner at Brookfield with over 20 years of infrastructure and power expertise, and in the energy group at Credit Suisse with a focus on M&A and leveraged financings. And with that, I would like to open up the floor for questions.
All right, Ed Eisenhower's online. He asked a question. He says it's good to see you. And it would be nice to see you in class today, too. So he's talking about the operating income. Your estimate for 2019 is substantially higher than 2018. That's a big jump. Why?
So they, in the last year, have started outsourcing their operation and maintenance to reduce costs there, as well as the conversion to the long-term service agreements with GE. They're going to be reducing incremental costs related to that by about $20 million because they'll be taking over the maintenance part of that, which is not core to their business. So that's really operating.
Okay, so I get the first follow-up question to Ed, all right? First, I thought this might have been a typo when I looked at it earlier in the week. Your ROA, ROE, ROIC. I thought maybe you got that in the wrong scale. Okay, they're low and they're way below the WACC.
Yeah.
What is that? We're investing in a company that's got basically a 0% ROIC with a WACC higher than that.
So currently, right now, they're identifying which of their assets are underperforming, and they're either recycling capital to get rid of those and put that into new assets that they believe will reach their growth targets, or converting old assets to new platforms like the wind repowering opportunities where they're enhancing their current asset value. So right now what you're seeing is them putting the capital into all these assets. And in the coming years, I believe the net income will reflect the efficiency of the new assets and that those ratios will come up. And for the ROIC, I believe that the dividend growth they're projecting will make up for that.
A lot in there. So the higher operating income should address what appears to be a low return on invested capital, is what you're saying.
Yeah.
You know what that would be? What does ROIC become?
In the future years, it'll pass my WACC.
Okay. All right, that's it for me. Patrick.
Stock is up 60% year to date, and the street recently moved to the sidelines. And thinking of pullback, what is our risk there? Should we be worried?
So when they made that update, they were reducing it to market appreciation based on the share price. But if you look into it, they both, or the JP Morgan report, I assume is what you're talking about, they state that there could be upside to their estimates based on if they're executing on the projects that they do successfully. And the dividend payment will also provide yield that market appreciation doesn't have.
Can you just justify why you decided to include SunPower in your EBITDA calculation? Because that's the only thing that's keeping that from being negative.
Yeah, so I included SunPower because of their capital structure and the operations they have. They're pretty similar to Terraform. However, I wanted to weight them low due to the fact that they currently have negative shareholders' equity, and I do not believe we're profitable, so that's why their ratios are a little out of sorts, and that's why I weighted them lower.
And Derek knows the trick. He's wearing a brewer's hat, so of course you get called on.
Yeah. Can you just talk about like the Brookfield sponsorship and do you have any examples of companies that have been sponsored by them in the past and how it's like helped their operations?
Yeah, sure. So Brookfield's only other renewable asset sponsor is Brookfield Renewable Partners, which they've had an average equity IRR on of around 19%, I believe. And so that company has grown significantly through them. And then with the acquisition of SETA and AltaGas's DG platform, that was kind of proving to investors that Brookfield Renewable and Terraform can both perform underneath the sponsorship.
All right, don't worry, Dr. Wall's still here, okay? He might ask some questions, but let's get some others here first. You don't have to talk about that dividend. What's the history? I mean, it's 4.6 right now. My goodness, that's twice any interest rate on a bond that's out there right now. What's been their history, and what do you foresee for dividend policy in the future?
So this dividend policy is supposed to be through 2022, and with our holding period of 3 to 5 years, I think that should be easily accomplished because they pay that out of their cash available for distribution, which they have a target payout ratio of 80 to 85%. And they're projecting their cash flow from distribution to be around $1.14 per share to $1.22 per share, which would be just in line with their payout ratio and ability to
So
grow.
that gave you comfort using the DDM model?
Yes.
When you ran the DDM versus the others, similar results?
Yeah, so originally when I had my first 3 valuation metrics, the target price off their ratings was $21.93, and that was the exact target price I got with my dividend discount model, so it was in line and I wanted to include it.
Dr. Wall?
A little easier or?
Doesn't matter. Good, Sure, how about that?
How'd you not win the tax credits?
So that's a good question because with the election coming up, and I know we discussed this previously, there's a potential that a lot of these renewable energy tax credits will be being phased out.
They're currently being phased out,
Yeah.
not potential. So how'd you model that?
I modeled out, so they currently have $2 billion in net operating losses as well as tax credits that are not being phased out from other countries in their operations. So I modeled out a slight tax benefit of around 7% going forward. However, if I took out all of those benefits and modeled in a 10% around effective tax rate, which is what they paid in a one-off year when they didn't receive tax credits, there would still be an upside to the stock.
Okay. And given that situation, right, because the credits could go away and that sort of thing, and you got a 10, what kind of upside do you have with no credits? I'll stay in this vein.
It was actually pretty close to the same. The change in tax benefit to a tax rate of 10% around that didn't really change the value.
So the value of the stock is not affected at all by tax credits, despite the fact there's $2 billion worth of them?
There's $2 billion in net operating loss carryforwards available.
So that doesn't affect value at all. Wow, I didn't know there were 2 billion shares of this company, or I guess 200 billion shares of the company. Because last I checked, if I had $2 billion of tax credits, and I had 2 billion shares of stock, which I doubt they have, that's $1 a share in earnings. And every DCF and every model I've ever seen, $1 a share change in earnings changes my value by quite a bit.
Yeah.
Pretty robust model to not have any effect when you drop over $1 in earnings and have no effect on the share price.
Welcome back, Dr. Wall.
So a lot of, I guess, what I could say to give a little more color on the tax credits is that a lot of the companies in that space don't have enough taxable income to even take advantage of these.
Yeah.
So what they did is
If you're trying to sell us something, they're going to make money, right? If they're going to make money, those tax credits are supposedly worth something. Therefore, you can't have your cake and eat it too. If these ratios are going to go up and not be 0.09%, the tax credits are going to be worth something. if the tax credits are worth something, it has to change the value of your company substantially.
So they with the tax credits, they like I said, they don't have a lot of taxable income to take advantage of these, so they monetize the tax benefits by entering into equity finance or tax equity financings with other investors. And so what that entails is the investor and Terraform.
Going back to my very first question, and I'll stop after this.
Okay.
Try to turn it into a teaching moment and a question. If, and I picked the medium one, keep in mind, if they were to turn those into tips, if they were to sell off their tax benefits to other companies, right? And then they go away, they have no benefits to sell. That's a significant change in their earnings. So one of two things is true. You're either pitching on the idea that there's no earnings in that situation, but it doesn't affect your model, or there are earnings that are going to be significantly changed. I would encourage you to revisit your model.
Okay.
We're gonna do Bill and Robbie, and then next presenter. Bill,
Why don't we just buy Brookfield?
That's another.
asset management?
Yep.
It's too. I have
Well, on
to.
the renewable side of it, they have a public company, don't they?
Yeah, Brookfield Renewable. They're not in the small cap venture.
Well, take still look at this. I'm gonna take it, the hard side of this, that Brookfield, asset buys 65% of this company. This company leverages up, it accepts all the leverage that Brookfield says they're going to buy. And so you're holding a company now that has 275% debt equity. It can't cover its dividend, even though they say they use distributed. It looks like, I mean, it's like kind of a Brookfield is playing.
So
Shareholders of this company.
So what's the question?
My observation.
Observation, okay.
their debt is staggered and doesn't. They don't have any maturities due until 2023 and then 2025 after that. So the dividend growth through 2022, which is what I modeled out, should be not get affected by
I'm taking the case that Brookfield's leveraging up another company to get 65% of it, so they get the benefit of it.
Okay, so you get the last word. Why don't you do a summary of your recommendation? And if there's anything you heard here you want to address.
Sure. So I just think that this would provide a really, or it would help to diversify our holdings in as the energy industry shifts away from fossil fuels to renewables. I think that they've got a good market share, especially as the distributed generation market takes off inside of those renewables. And I do think that with the stable cash flows they provide and the tax benefits that we're receiving right now and the projected dividend growth, that it'll be a value play for us and it'll outperform the peers that we have in the portfolio currently.
Don't forget that dividend, 4.6. Last time I checked, Treasury bonds are yielding 1.7. So that's just. Connor, thank you. All right, Luke. You want to take a tennis racket up there to hit balls at people that ask questions?
Sure, yeah,
All right, this will be our only international stock that's presented today. Luke, you all set?
Yep.
Got family joining us online or anything?
Not that I know of.
There's their eyes out there, all right. Okay. All right, floor is yours.
So I am the international healthcare analyst here. And today I'll be pitching to you Fresenius, ticker FSNUY. Fresenius is a global healthcare company that focuses mainly on the dialysis treatment. So dialysis removes waste, salt, and water from the blood to treat kidney failure. And Fresenius operates through four main segments: the medical care segment, private hospitals, IV drugs, biosimilars, clinical nutrition, as well as their four managing healthcare facilities. So I'm going to start with my drivers and go briefly over those before I get to my recommendation. My first driver is the global dialysis market, where Fresenius is the global leader with a market share of 35%, and where our market is expected to grow to $124 billion by 2024. The number of patients with chronic kidney disease, grows at 5 to 6% each year. And so with the aging population rising globally, this presents an opportunity for Fresenius to grab even more market share, as well as the growing number of people is mainly due from diabetes and high blood pressure. Moving on to my second driver is Fresenius Kabi. This segment focuses on IV drugs, clinical nutrition, infusion therapy, and biosimilars, where demand is set to increase by 7% in 2019 and remain in the high single digits for the next 5 years. The demand for these generic drugs and biosimilars is driven mainly by originators' high prices and generic low prices. And so we're seeing a change in the healthcare industry a little bit where branded drugs are continuously having increasing prices. And so with these lowering prices for off-brand products, such as a biosimilar, which is a drug that is an almost identical copy of an original one, once it is approved from an original patent that expires. And so $1.2 billion is being invested into Fresenius Kabi, mainly to expand their production sites with R&D and ultimately produce more biosimilars in the future, which they have not done in the past. So this presents a big opportunity in this segment. My third driver is capital expenditures in emerging markets. 2019 is quoted by the company as the year of investment, with over $4.1 billion being invested overall. And so with main facilities being in North America and Europe, focusing on there as they have 42% of sales and 43% respectively in those regions. Emerging markets also present a new opportunity, particularly in Asia and Latin America, where healthcare spending is increasing in those countries to increase their overall standard of living and quality of treatment. Particularly Asia's elder population is a hotspot in Asia, with the percentage of people over 65 doubling in the next 10 years from 7% to 16%. In Japan, particularly, the percentage is expected to grow to 37% of population by 2030, and South Korea is seeing the fastest growth of any elder nation, growing from 18% to 31% by 2030. And so mainly this applies to the dialysis market, where those customers and patients are needed as they get older in age. They will need more dialysis treatments. And so tapping into the Asian markets, that presents one of the key opportunities moving forward. So overall, Fresenius is a global leader in the dialysis market. There's no other company that can be at the top like they are. And with the company investing so much in 2019, management knows that their ROIC will take a hit this year, but the investments being made now will ultimately pay off in the future as they can increase their production sites and manufacture more biosimilars and dialysis products in the future. Net income and earnings per share have decreased in 2019 due to the divestiture of a subsidiary called Sound Physicians, which accounted for $1 billion of non-operating income in 2018, which ultimately led to a higher than normal net income in 2018. And so moving forward this year, in 2019, February, Fresenius acquired Next Stage for $2 billion, which allows the company to move towards home care for dialysis treatments, which is one of the major trends in the US that they've lacked in 2018. And so moving towards more capital-intensive care will be one of their main things as well. Therefore, it is recommended that Fresenius be added to the AIM International Equity Fund with a price target of $15.57, a 23.25% upside. I'm going to touch on a few of my risks, just to go over those a few. If you want to ask me about my valuation, you can during Q&A. So one of the major risks for Fresenius is their competition. In 2018, their net income and their overall earnings were not as well as they expected, which saw the price take a 25% hit at the end of 2018. The dialysis market in the US is very competitive, and they did not perform as they wanted to there. Currency changes are also a big risk for the company, whereas in 2018, the translation accounted for 4% loss of their overall sales and net income. I'd now like to open up for the questions.
All right, I'll kick it off here. Of the four stocks today, this has the highest weighted average cost of capital.
Yes.
It's not extraordinarily high, but it's the highest. And this company has a debt to equity ratio of about 1 to 1. And this is a German company. So Germany is a pretty stable country and interest rates are really low. I'm kind of surprised. Can you walk me through your WACC?
Yeah, so
8.2.
to get that 8%, I did not use the current risk-free rate, which is negative, and so if I did, my WACC would be around 5 to 6%. So that would obviously look a lot better on paper right now, but I used a risk-free rate that I thought would be normal in the coming future, so that's why it's a bit higher, 8%.
Okay. All right. Patrick.
I noticed in the investor presentation that your biggest segment, the largest segment, medical care, they only own 31% of that. Could you just touch on that?
No, they fully own the Fresenius medical care.
All right.
I believe so.
Okay. Questions? Yes.
Your last risk was about currency and the exchange rate between the euro and the dollar. Did you run any sensitivity on this?
No, I did not.
Okay, that's fine. That's fine.
Let's talk about valuation just a little bit. What do you place the most stock in, and did you run a sensitivity analysis?
Yeah, I did for sure. My DCF gave me an intrinsic value of $18.26 with a sensitivity range of $13 to $24 roughly. And so I think my DCF is a good sense of valuation for this. I also had income taxes a little bit higher than they normally were in the past to account for that. So I think that's a good sense of valuation there. And particularly my PE valuation as well. If you look at compared to the peers, they're outperforming them just by a little bit. So I think that's a good sense of direction for the company.
Okay, Phil, Next Stage Medical is home dialysis, and Fresenius is on site.
Yes.
Are you worried about cannibalization between the two?
No, I think Fresenius is also, they're moving towards more home dialysis treatments as well. So what they're acquiring of Next Stage, that's only going to help them moving forward, as more people now in the US are going to want that. And so being able to offer both is ultimately going to help them.
Questions? Well, we can't go without asking about healthcare. I mean, what would a Medicare for all or a change in the U.S. healthcare system, even though this is a German company, they do sell a lot of equipment in the U.S., how might that change your outlook? Did you stress test, and is it a risk?
Yeah, that's one of my risks is changes in the U.S. administration with Medicare and Medicaid. A lot of it comes through, 33% of sales in 2018 were through Medicare and Medicaid programs. And so that's always going to be a risk, depending on what the administration looks like. So that's kind of an uncertainty moving forward, but that's one of the risks.
Dr. Wall, all set?
All right. So I actually, thanks. You went in my office, you fixed the WACC, and it looks better. I like the valuation approach. What I can't remember, and sorry I'm tired and I don't mean to dig up an old thread, is what did you do with the currency? You didn't model it originally in the original currency, is that right?
Yes, I did it in dollars.
Yep. And so after we talked, have you done any currency analysis of how it affects things? Have you at least looked at the future projects and what this means to your modeling in the past?
Yeah, I did. So I think the dollar compared to the euro, if I did use it in dollars, if anything, it would help my valuation moving forward and for the years that I've forecasted out and the expecting forecast of the euro compared to the dollar.
Okay, so the euro is supposed to appreciate relative to the dollar going forward, and you modeled everything in dollars. Is that correct?
Yes.
And how much did you benefit in the past from that situation, or did you not benefit?
I don't know by how much I benefited,
Okay,
but I don't think I benefited modeling in dollars.
so it sounds good because projections are based on the future. This is more of a teaching moment. But when you do an ADR, and we have this discussion, it seems like annually in this room, and I think it's an important one that we have early on. It's really important that you model the company in the host currency, because otherwise you're modeling in currency effects and you're capturing, like, let's say the currency appreciated 10%, and now it looks like the company appreciated 10%, but the company didn't grow at all. So you run the risk that your whole model is being based on currency moves rather than what the company is actually. So typically we model in the host currency and we translate back into whatever we need to do, and we can run projections. And as he did, which is really useful, you have futures markets to rely on for the future, right? You can go to things like futures markets or forwards. You have some basis, or economists make forecasts for those things that you then can put into your DCF when you convert back, and it helps a lot. Looks like we're the beneficiary of a currency move here through luck, but it could have just as easily went the other way, and now we'd be spending all our time talking about, well, what's the company worth?
Right.
Make sense?
Okay, so you got an ESG of double B. Now that surprises me. German company, healthcare, you know, they're not extracting hydrocarbons out of the ground or burning. What, you have any idea why the ESG is a relatively low rating?
Yes, they've had some social issues in the past with some bribery scandals and charges, so that's mainly one of the big reasons why they're rated so low.
Was that listed as a risk of any?
It's all been resolved. In the past, they've confessed that they've made mistakes in the past, so that's why they've been rated so low.
Well, that begs the follow-up. Did they change management? Can you talk about the current management team?
Yeah, their current management team. I believe a lot of the problems also happened before some of the management that were there now. The management there, they've been there for around 5 years. The CEO, 5 to 7 years. The new CFO was appointed in 2017. So some of the problems have been ongoing since 2010. So they're constantly looking to improve.
All right, Luke, thank you very much. Right, halfway there. So now we move into small cap space again, back to the US. All right, everybody set? Gino, want to introduce people in the room we should know?
Yes, my parents are here today. Thanks, guys, for coming. But good afternoon, everyone. For those of you who don't know me, my name is Gino Piscopo. I'm a senior in the AIM program, and I cover the consumer staples sector. Before we begin, I'd like to thank everybody for coming. But today I'm going to be pitching New Skin Enterprises, ticker NUS. New Skin develops and distributes premium quality beauty and wellness solutions. The company offers anti-aging personal care products and nutritional supplements under its New Skin and Pharmanics category brands. Further, 33% of revenue derives from China, and collectively the Asia-Pacific region is responsible for generating 77% of revenues. The company was founded more than 30 years ago and is headquartered in Provo, Utah. Moving on to my recommendation. The global cosmetic product market is expected to grow at a CAGR of 7%, reaching more than $863 billion by 2024. This growth primarily will come from China, where New Skin derives a large portion of the revenue. Also, since 2015, the global market has grown 5% annually due to a large influx of new product releases, which was the result of increased competitive product innovation, resulting in suppliers increasing prices. The use and application of these new products within the cosmetic products industry often require a certain level of training to be administered properly. Keeping this in mind, management aims to allocate more research to social media, especially during product releases. For example, when New Skin released their new Age Lock Lumi Spa Kit in 2018, Google searches increased by 400%. Alongside this spa kit, New Skin also sells their Galvanic Spa. Both of these products are handheld devices that rotate and oscillate to deliver nutrients and ingredients to the skin to make them look younger and healthier. On a different note, New Skin gives back to their communities through their Force for Good Foundation, which started when one of their founders used that phrase, Force for Good, to describe his vision for the company. 3 years later, New Skin started donating a portion of every sale to humanitarian projects. For example, in just the first quarter of 2019, Force for Good provided over 13 million meals across the globe. Through these charitable practices, their award-winning products, and social media initiatives, New Skin will increase revenue and market share. As a result, it is recommended that New Skin be added to the AIM Small Cap Equity Fund with a price target of $53.48, representing a potential upside of 25%. Moving on to my first driver. In 2017, the market for beauty devices was around $34 billion, and by 2024 it is expected to triple and reach $97 billion. A lot of this growth is attributed to China, since it is the second largest beauty market around the world and with a large aging population. The aging population continues to grow, and By 2020, it is expected that most of Chinese population will be above the age of 45. Also, the updated galvanic spa appeals to a broader customer base, including millennials and Generation Z. Nu Skin will fully capitalize on this growth because of this release, and since they constantly receive product awards. Through all this growth, Nu Skin's beauty devices as a percentage of revenue will represent 39% in 2024, compared to 20% today. Secondly, as I mentioned before, customers of Nu Skin often need education to properly use each product, and because of this, management has pivoted to marketing on social media outlets through sharing initiatives. This could be anything from users demonstrating how to use each product, or reviewing when new products come out, or if the company is wanting to share environmental impacts with the public. Recently, one of the bigger topics shared by the company is their upcoming event called Live. On top of being the largest meeting Nu Skin holds, there will be guest stars like Gwen Stefani and Hans Zimmer. Plus, it will be completely emission-free. Aspects like these bring large amounts of awareness to the company, increasing their sales force. Additionally, brand awareness will continue to grow with the release of Velocity, a bonus program designed to optimize sales leader performance based on individual market needs, to promote a more flexible, fast, and fulfilling business. Velocity is funded by slightly higher prices, and selling expenses as a percent of revenue is going to increase. Overall profit margin will increase 30 basis points by 2024, adding around 16 cents to EPS. For my valuation, a 5-year DCF was constructed, resulting in an intrinsic value of $52. And an EV to EBITDA multiple valuation was calculated, resulting in a value of $53.63. Lastly, dividend discount model valuation was calculated using the trailing 12 months dividend, a 1.3 growth rate, and a cost of equity of 7.9%. The DDM also includes share repurchases of 3.5% of revenue, which resulted in a value of $47.82. I decided to include share repurchases because of management's strategy to consistently buy back shares. Because of this, it makes it indistinguishable from dividends and creates shareholder value. By weighting the three models 50, 25, 25, a price target of $53.48 was reached, resulting in a 25 potential upside. The firm pays a quarterly dividend increasing on average of 2 cents per year. Last year's dividend totaled $1.48, yielding around 3.5%. To save time for questions, I'm going to skip my list and briefly talk about management. Rich Wood has served as CEO since March of 2017. Mr. Wood joined the company in 1993 and served in numerous roles before being named as CFO. This includes Vice President of Finance and Vice President of New Market Development. And with that, I'd like to open up the floor to questions.
All right, you ready for a real zinger to start out with?
Let's hear it.
All right, Ben's brother, Alex, was an AIM alum. So hello, Alex. How are you up there? You have a risk listed as brand reputation.
Sure.
So he's saying, are you referencing the allegations that the company is a glorified pyramid scheme? Any concerns about that going forward?
Good question, Alex. Alex is asking about the allegations that my company is a pyramid scheme. To back up just a little bit, I would like to explain the business model of my company. To buy their product either online, we need to know a distributor who's also an existing customer that partnered up with the company to sell their product. These individuals, in their free time, sell this product for extra commission and have no minimal sales requirement. And because they have no sales minimum requirement, I don't believe that they fit into this scheme per se. And on top of this, a lot of those allegations were due to them being called a pyramid scheme, but a lot of pyramid schemes don't have any merit. And I feel like this company, with their product being ranked number one and their continued release of new products, interest in the market has continually increased. And because of that, I don't agree with those allegations.
Let's see if we can get Family Feud going here. So we expect the Piscopo is on to ask Schmidt.
I see that two of their main suppliers are from China and Hong Kong. Do they see anything with like tariffs or anything like that?
Yeah, that's a great question. The question was regarding tariffs and I'm assuming trade war with us in general. Like Alex was saying, a lot of their suppliers are in China and they manufacture a lot of their products where they distribute them. So because of that, they're not going to be facing any import tariffs. And so I'm pretty confident with that exposure to China.
Over here, Austin. No,
Okay. So you included in your yes. You included in your peers Oil Dry when their revenues and their market cap are both significantly smaller, yet you still weighted them the same. Can you elaborate a little bit more on that, on why you weighted it the same?
Yeah, Riley was asking about how I chose my comps and decided to add Oil Dry. I decided to add Oil Dry in Central Garden Pet Company for two reasons. Oil Dry, I think, operates similar to them and has a pretty high ROE for the amount of leverage that they have and the size that they have. And Central Garden Pet Company, I think, is going to be my sell recommendation. And I wanted to compare the two values because Central Garden Pet Company recently performed poorly, but then also has similar margins as New Stand. Thank you.
Chase.
You list your beauty products as premium quality. Are they like how much do these products run for? Like,
Yeah.
if I were to go to the store and buy one.
Yeah, she's asking
And
about.
would he, is that is it gender neutral?
Most of the products are marketed to the aging population for females, but there are some products like nutrients and other creams that men have used in the past. But products like the galvanic spa can range from $600 and the Lumi spa can be around $400. So that really sends back to how management markets this product to people that could actually have the means to buy this product. And going back to just maybe like recessionary pressures, I think that's really a big defense there because these people that are marketed towards, they have the means to buy these products and kind of view these products as premium like shampoos and body washes, which are kind of household necessities.
Gino, 5 people want to ask questions, so we'll go to lightning round now.
That's
Bill?
it.
How did you handle the stock buyback and the terminal value of your DDM calculation?
The question was regarding my terminal value. Are you asking in regards to my DCF?
DCF, yes.
Yeah, so my DCF and DDM are completely separate valuations. I started with the current price for my DDM, and then when I divided my enterprise value by my shares outstanding, I just used the full diluted as of the last quarter of the
For in the DDM model, you said you include per share purchases in your DDM.
Correct.
That's what I was.
Yeah, sorry about that.
What did you do? How did you handle your terminal value of your calculation with that?
Well, what I did was I took 3.5% of, which is a little bit below their average share repurchases throughout the year, and also that by my revenue and got like a total value number, and then divided that total value number by a share price to get like the amount of shares, and then added back their average like executive compensation that gets added every year, and that kind of just funneled down. But when I calculated like the enterprise value, it was just a simple growth model off of on a per share basis, how much money they were giving back to shareholders, divided by my cost of equity minus the growth rate assumed of just the dividend, not the share purchases.
Bobby?
Give us your thoughts on the potential risks that strengthening of the U.S. dollar could hurt your company's performance.
Yeah, the question was regarding the strength in the U.S. dollar, and like I mentioned before, they manufacture their products where they distribute them, but they buy their products in U.S. dollars. So as the price or as the dollar strengthens, the cost of goods sold goes up, bringing down gross profit. And in the past year, the dollar has strengthened, and people have been hedging with gold and other safe havens. And then in October, Trump has another meeting with the president of China to conclude trade talks. And I think with that meeting coming up and the news that will follow, hopefully the dollar goes down a little bit, helping the margins.
Patrick?
Thank you. Could you just touch on stock price? It's been pretty volatile and it's had some price target downgrades in the last 3 months at 30%. Could you just touch on?
Yeah, Patrick was asking about the stock performance over the last year. And in quarter two, as I mentioned in my first script, China held this 100-day campaign to review and inspect the health products and direct selling industries. And during this time, they weren't able to host any meetings to build up their sales force. And while the news came out about this campaign, management readjusted their guidance a little bit lower, and on that, the stock price took a hit. And that's part of the screening process. I think that this company, the market overreacted to that news. Actually, in quarter three, their entire customer base grew by 8%. And I think through that fact and through the fact that they held their largest meeting in China just recently in July, I think China is still going to be a healthy market for them to.
Yeah, so you have revenues decreasing by about 7%. One of your drivers is regarding this segment that's going to grow 90% year over year. So I'm kind of wondering which segments are going to, if you have that one growing so fast, which segment's going to decrease to justify that dip in revenue? And then I would also, I'm curious as to how you have your operating income growing so substantially with revenues decreasing by almost $200 million.
If I could just add a little bit more clarity, in 2018, they released a new product, and that's where you see like a big revenue jump. Going into 2019, the reason that the revenues decreased was because of the headwinds that I mentioned in China. Those operating income numbers are, or operating margin numbers rather, are pretty in line with where they operated in the past. And I mentioned 30%, 30 basis points from that velocity bonus program will funnel down to EPS, creating around like 16 cents of value.
We should vote on the question you're gonna ask. Mild, moderate, or hard? What do you want?
Let's see.
All right.
That's got curveball.
Oh, what's that?
What you didn't see behind you, which was beautiful, is that Trump just announced, right, that he is considering delisting all the Chinese stocks. And in retaliation, China is already announcing potentially taking out U.S. businesses like Newscan. If that happens, how much will your shares be worth?
I don't think that China will go through that. I think these are just threats that Trump is putting out and that Xi Jinping is putting out as well to kind of
Last
out
time
some
he
of these
made
trade
a
talks
threat, there was
and
100
show that they have
on your business. So let me rephrase. Last time he made a threat, there was a 100-day moratorium put on your business, which I agree with. Moratorium on hiring and such, which I agree with you, the market overreacted. So let me rephrase. If you don't believe it's going to really come to play, this seems like a pretty serious threat. And if last time the response was 100 days, what would it be this time, and what effect would that have?
100%. I think if business were to get kicked out, I don't see that coming into play, but shares would definitely be devalued.
And
They would lose a large portion of their growth.
Don't open the hole. You know I was going to go down, so let's see if you did it. You did all these repurchases in your DDM. We talked about it together. I know your work. You're going to have done this, but that's okay. Let's prove it out. When you make all these adjustments for repurchases, you have to account for, in your terminal and all along the way, what's going to be paid out in compensation and buybacks. What did you do to account for management compensation and buybacks that are built into that?
For management compensation, I was looking at the spread between diluted shares and the shares currently outstanding and saw that spread and then kind of read a little bit about their executive compensation, which is pretty advanced but intense for these executives to hit their marks. And because of that, I added back a certain portion of shares back. And it was an average of that spread divided by 5 because I did it over 5 years. I wanted just to see out what the payout ratio was. And through that, my beginning was they start out with about like 56 million in shares outstanding, and then I have a forecast around 50 million, and that decrease is pretty standard. In 2012, they're around 61 million, which is another 5 million decrease. So it's been pretty consistent. In the past 2 years, they've been paying out or buying back shares around 2% of the revenue, but there's been years where they had 11 or 15% of those.
Is this your last pitch?
Second last.
He's gonna be in New York.
Thanks.
We're gonna
Well,
Last one here.
Well, thank you. It's been a privilege to have you.
Yeah, thanks for all that.
Wow. We'll see if you get the same accolade, Mr. Schmidt. Nice job, Gino. All right. Gentlemen, we need chairs, if you don't mind. Very good. So Gino and Ben are the FMA co-presidents, and they'll be presenting in New York as well. So that's not that far away, right?
Yeah, when we go off.
And when they go up and where we go. All right. So Ben, where we go? Final presentation of the day.
Well, first off, I want to thank my mom and my brother tuning in. Thanks for coming. Good afternoon, everyone. My name is Ben Schmidt. I'm a senior in the AIM program. I'm covering the domestic and international energy portfolio with Connor, and I want to start with my screening process much like Connor. I want to transition away from the fossil fuels predominantly located in the Permian Basin, since they're obviously not performing, and I think global sentiment is changing from fossil fuels to renewable energy. I thought Ameresco was going to be the best company that bridges the gap between fossil fuels and the renewable solutions because they have a segment of their business doing renewable and then as well as energy efficient solutions. So at its core, Ameresco engages in the provision of energy services through energy efficiency, infrastructure upgrades, asset sustainability, and renewable energy solutions. Since that's usually abstract for us in energy, I think it's probably better if I just skip the recommendation and go through the product segments and how they derive their revenue. So the projects, which make up about 70% of their fiscal year 18 revenue, it's pretty much their bread and butter of the business. This is their energy efficient solution aspects to the business. So how it works is that they get contracted from federal agencies and municipalities or like public universities, and then they go in and upgrade or retrofit anything from LED lights to the whole generation plant. The generation plant usually are they get granted a higher price and higher margin for them because there's more technical expertise. And that's something that Ameresco is starting to differentiate themselves with, is a technical expertise aspect to it. They're using distributed generation, as Connor mentioned before. They're using microgrid, and they're using battery storage. And this has allowed them to expand their addressable market from about 8 to 10 billion to 20 billion on an annual basis. Second, you have operations and maintenance, which derives about 8% of their fiscal year 18 revenue. Once they complete an energy efficient project, they will maintenance it for about 14 to 20 years. This is fixed pricing, and it's year over year they adjust the pricing, and it's recurring revenue of their business, which is what they're trying to expand. Third, you got energy assets. This is where they're starting to place an emphasis on and direct their capital expenditures to. There's a lot of recurring revenue in this, and so if they make about 100 million in revenue, about 50 of this goes to the bottom line. And that's why I want to do it, just because the capex in the project is not, or the cost of expenditures in the project is not that enticing, although it is a big part of their business segment. Lastly, you have the other segment, which is 10%. That consists of solar panels as well as energy management consulting services. Due to positive market dynamics and Ameresco's amassed backlog over a diversified revenue stream, it is recommended that AMRC be added to the AIM equity fund with a price target of $19.26, representing a potential upside of 18.43% as of Wednesday's closing price. As I just mentioned, the energy asset diversification and the emphasis they're placing on that. So as I mentioned by write-up, in 1Q 2019, they opened the first biogas to RNG solution for the city of Phoenix, Arizona. It's going to generate up to 7 megawatts equivalents on a full capacity scale on an annual basis, and this should translate into about 7 million in EBITDA. In 2020 and 2021, they're going to build 2 more of those in California, and then 5 to 7 thereafter. I think that really leads into my second driver, their first mover advantage, because they're placing an emphasis of getting their assets in place not only on the East Coast, but the West Coast. And the West Coast usually implements laws faster than the East Coast. And with this natural gas installation ban, no more natural gas installations, I think there can't be, because they're forcing out the natural gas and want to do renewable solutions, there's no way that they're going to go from fossil fuels directly to renewables, because the renewables just don't have the energy capacity to do so. So I think the natural gas companies are going to provide the bridge, and they're going to lobby for renewable natural gas, because that's a great solution at the time, rather than transforming all their assets that produce natural gas and crude oil over to a renewable solution. So Ameresco is going to be in the best position for this renewable gas, and their assets are already going to get in place when this market size increases. Lastly, you have the project backlog diversification. You might see this in my model, but in 16 to 18, they started winning more complex projects with their technical expertise. Before, they were winning low margin, low cost projects just because there wasn't much differentiating capabilities that they're providing. Now that they're doing that, it's estimated that they can increase their gross margin by up to 200 bips by 2023. And that's where you're getting the gross margin expansion and the operating income expansion. And then something else to note, in 2019, they're flushing out a lot of these low margin projects in 2019, so they can tap into the backlog of these complex projects and derive more revenue as well as higher margins. Moving into my valuation, I constructed 3 different valuation models. One was a 5-year DCF with a WACC of 7.14%. That resulted in a price of $18.63. Second, I calculated EV to sales using a multiple of 1.2 times. That resulted in 21.78 intrinsic value. And then lastly was an EBITDA multiple calculation with multiple of 9.1 times, and that resulted in an intrinsic value of $17.57. Lastly, I want to touch on management. George Sakalaris founded the company in 2000. He is currently the president, CEO, and chairman of Ameresco. Now, with that, I'd like to open the floor to any questions.
Whew, this reads a little better than that Saturday version I saw. So now we know what the company does too. Challenging company. So
Yeah, interesting as well.
we got to do ESG in honor of our guest last week, Double B. Any comments on that?
Yeah, that's actually a good question. I thought it'd be higher since it was like a renewable energy efficient company. But apparently, since they derive a lot of their revenues from the federal government, and that George Sakalaris holds 80% of the voting power, that tends to downgrade the ESG.
Okay, there's going to be sibling rivalry now. Alex, your brother, asked you to reference a couple of recent acquisitions. Have these been successfully integrated? Does your growth metric incorporate these acquisitions? If so, what's the difference between your organic and inorganic growth?
That's a good question, Alex. Thank you. In terms of how's it factored into my model, I have SGA decreasing about 10 basis points year over year because I think the operational expertise that they bring to the table is better than Ameresco's in terms of solar panels. In addition to that, or inorganically, they added up to about 10 to 12 megawatt equivalents of solar panels and installation that are already installed. And then their backlog is estimated to be about 100 megawatts equivalents more in the future. So I would say right now they added top line inorganically, but then organically they're going to be able to grow, and then the cost synergies are going to roll into the SG&A.
So I'll do the follow-up for me. Do you like the management team, and have they been successful in integrating past acquisitions?
Yes, so far they have. They've been acquiring since pretty much they became public, and they place an emphasis in their 10K, and management has mentioned multiple times that they want to grow inorganically as well as organically, just because of the operational expertise required. I mean, management has it, and I think George Sakalaris has a good vision for the company, but it doesn't help to have people below.
He didn't plant that question, right?
No.
Okay, all
Alright. So do we get a transfer? Go here.
So Nico's brothers texted me, Joey and Nico, and said, on your page 13 of your peer validation, the EV EBITDA percentages only add up to 90, not 100%. We're wondering what the other 10% was.
That's a good question. If it's 10% upside. 10% upside.
All right, Bill.
You quote that your backlog has increased 15% over the past 3 years to 1.9 billion. Growth rate in revenues has been far less than that. What is the dislocation between the revenue growth that's being reported and the revenue growth that's backlog?
That's a good question. So I want to expand on that a little bit. So the contracted backlog is RFPs that are won, and then our contract with the customer and the agreements all worked out. In the past 2 years, from 16 to 18, they've been winning a lot of awarded contracts where they win the RFP, but haven't come to terms yet on like the exact cost and the timing of the project. And since these are a little bit more complex projects, the details still need to get worked out. But historically, they convert the awarded backlog about upwards of 90%.
Patrick.
I guess I'm just wondering, is there any concern based on how small they are and the capital intensive projects accounting for 70% of the revenue? Is there a risk that a big company can come in and lock us out?
So the question was, is there concern about a bigger player coming in and doing the same thing we do? Certainly that's a concern. They compete with like Johnson Controls. You see the bottom tier of my box, they have a market cap of $37 billion. But I think a benefit to them is that they are able to develop relationships and become close with the teams that they're going to be working for and developing the projects for. So I think in that aspect it's good, but obviously when it comes down to sheer economies of scale, they aren't going to be able to compete with the bigger projects. But a nice thing is most of the plants that they construct are under 20 megawatts. So
My question is in regards to your second driver. You touch on how they're gaining market share. Is this RNG market share part of the 20 billion that you touch on in the recommendation, or is that separate? And then could you also touch on like how you decided to model that?
So the question was on my second driver. This is more a qualitative driver. I didn't want to estimate the market because I didn't know what the transition would be from natural gas to renewable natural gas. I mean, California's probably, I think, the third largest consumer of energy or somewhere around there. So the market's going to be huge, and already some cities already use renewable natural gas. It's only going to increase. I can get back to you though on that, but do some more digging on that issue.
Before we have Dr. Wall's question, your brother gave you a shot and said, next time answer in English, okay?
Fair enough, right? You want easy, medium, or hard?
Everyone else said hard, so I guess.
Okay, you thought about a medium. Good choice. What do you want?
I guess hard.
All right.
All right,
I think well, we talked about this in the office, so you got a shot at it, right? Well, I don't know where you came up with that idea about renewable supplanting regular gas, but no. In our no, we talked about this in the office, but did you quantify it, right? So Berkeley, California, a lot of major municipalities have flat out banned natural gas of all types. Right now, they've codified it in law. So should his driver not come to be that these other bigger companies take care of the problem for him, for lack of a better term, then there's a serious problem in getting natural gas growth rates going forward. Did you quantify what that risk might mean in terms of the downside to your stock?
I did not factor that in, no. I think right now, the only downside, the 10 landfill gas plants in California, as well as the 2 that they're planning on opening there. So I would estimate that to be around like $30 to $40 million. So I'd say going forward, and at least 30 to 40, and then bottom line,
What kind of long-term growth do you have on this thing? Because it's going to remove it, right? If that nightmare played out. What's your long-term growth rate on the company?
the perpetuity,
Yeah.
2%.
So if I strip that out, what's it look like? Ballpark.
Probably the value around like $7.
Okay, fair enough. And again, thank you too. Is this your last one?
Yeah. All right, New York.
Last pitch in the
Yeah, in
room.
the room. Thanks. You've been really helpful for the students. He's been really a good resource for us. So
Thank you.
very much. Yep.
Juniors, you're getting closer here, you realize that. And a year ago, they sat there as terrified as you, okay? So you can do this. We're learning bit by bit. You can see there's excellent senior mentors. You can tell by the questions asked that they've learned a lot, and they will help you as you continue to build out your skills. And you'll be up here with them following fall break. Just so everyone knows, we do the mentor protege model here, where the senior will still be up here presenting, but we put the junior alongside just to assure that, I guess you're like a caddy, if you will. But you will be assisting in the process, and you'll be asked a question or two. So nice presentations, gentlemen. What we need from the 4 of you is this weekend a quick write-up of anything that needs to be addressed based on questions today and your star recommendations. And then we'll get a ballot out Sunday night, and by Monday we'll know what gets added. So thanks, everyone. Have a good weekend, and let's thank our presenters. Do we get a right or left draft? So